The final quarter of the 20th century transformed American financial markets beyond recognition. Three forces, deregulation, technology, and globalization, combined to produce the longest and most powerful bull market in American history and to create a financial system of complexity, scale, and interconnection that its architects only partially understood. Deregulation began in 1975 when the SEC ended fixed commission rates on the NYSE, the direct descendant of the Buttonwood Agreement's original price-fixing arrangement. Negotiated commissions dramatically lowered the cost of trading, creating conditions for higher volume and eventually for the discount brokerage industry. Charles Schwab, founded in 1975, was the first major institution built on the premise that execution, not advice, was the commodity that most investors needed. The Depository Institutions Deregulation and Monetary Control Act of 1980 and the Garn-St. Germain Act of 1982 loosened restrictions on banks and savings institutions. The gradual erosion of Glass-Steagall, which culminated in its formal repeal by the Gramm-Leach-Bliley Act in 1999, progressively allowed commercial banks, investment banks, and insurance companies to enter each other's businesses, reconstituting the integrated financial conglomerates that the New Deal had broken apart. Technology changed the mechanics of markets fundamentally. The NASDAQ stock market, founded in 1971 as the world's first electronic stock exchange, demonstrated that computerized quote systems could replace the human specialist on the trading floor. Through the 1980s and 1990s, electronic trading systems expanded rapidly, compressing trading costs, accelerating execution speeds, and enabling a democratization of market access that would have been inconceivable to the Buttonwood brokers of 1792. The introduction of financial futures, contracts on stock indexes, interest rates, and currencies at the Chicago Mercantile Exchange in the 1970s and 1980s created new instruments for hedging and speculation that integrated commodity and securities markets in previously impossible ways. The 1980s were defined above all by the leveraged buyout boom and the junk bond market created by Michael Milken at Drexel Burnham Lambert. Milken's insight was that the spread between the yields of investment-grade and below investment-grade bonds was systematically too large relative to actual default rates, making high-yield debt an underpriced asset class. By using junk bonds to finance corporate acquisitions on a massive scale, Milken and the leveraged buyout firms he financed, Kohlberg Kravis Roberts foremost among them, transformed American corporate governance, forcing managements to maximize shareholder value under the discipline of heavy debt loads. The era also produced Ivan Boesky and the insider trading scandals of 1986 and 1987, which revealed the extent to which the information asymmetries of corporate deal-making had been systematically exploited and which led directly to significant strengthening of insider trading enforcement by the SEC. October 19, 1987, Black Monday, produced the largest single-day percentage decline in the Dow Jones Industrial Average in history, a fall of 22.6% in one session. The crash was partly attributed to portfolio insurance, a computerized hedging strategy that automatically sold stock index futures as the market fell, creating a feedback loop that amplified the decline. The speed and severity of the crash demonstrated for the first time how technology could accelerate market dynamics to the point of systemic danger. The Federal Reserve, under Alan Greenspan in only his second month as chairman, responded by flooding the financial system with liquidity, a response template that would be repeated in every subsequent market crisis, and that became known, approvingly and then critically, as the Greenspan put. Within 2 years, the market had recovered entirely. The 1990s produced the most extraordinary sustained bull market in American history, driven by genuine productivity gains from the information technology revolution, by the peace dividend of the Cold War's end, by the fiscal consolidation of the Clinton years, and increasingly by speculative enthusiasm for anything connected to the internet. The Dow rose from roughly 2,500 at the beginning of 1990 to over 11,700 by January 2000, an increase of nearly 370% in a decade. The democratization of investing reached its culmination with the emergence of online brokerages. E-Trade, Ameritrade, DLJ Direct, that allowed individual investors to execute trades in seconds at minimal cost. The day trading phenomenon of the late 1990s brought a new generation of retail speculators into the market, many of whom had no prior investment experience and all of whom were operating in the most overvalued market in American history. The dot-com bubble, which inflated spectacularly between 1998 and early 2000, was in structure recognizable from every previous speculative episode in the financial history described in this account. A genuine technological transformation, the internet was real, its economic implications were real, provided the narrative justification for valuations that bore no relationship to any calculable cash flows. Companies with no revenue, no earnings, and no credible path to profitability were valued in the hundreds of millions of dollars. The Nasdaq Composite Index, heavily weighted toward technology stocks, peaked at 5,048 in March 2000. Over the following 30 months, it fell to 1,114, a decline of 78%. Trillions of dollars in market value were destroyed. The financial television culture that had celebrated the bubble, most spectacularly on CNBC, was briefly chastened. The first decade of the 21st century delivered two of the most severe financial crises in American history within a span of 8 years, testing the regulatory architecture of the New Deal, the monetary tools of the Federal Reserve, and the resilience of a financial system that had grown through deregulation into extraordinary complexity. The dot-com crash of 2000 to 2002 was followed immediately by the September 11th terrorist attacks, which closed the NYSE for 4 trading sessions, the longest closure since the Great Depression, and produced a sharp market decline on reopening. The Federal Reserve responded to both the crash and the attacks with aggressive interest rate reductions, cutting the federal funds rate to 1% by 2003 and holding it there into 2004. The prolonged period of cheap money that resulted inflated a new bubble, not in technology stocks this time, but in residential real estate, and in the extraordinary financial structures built upon it. The securitization of mortgage debt, the pooling of thousands of individual home loans into tradable securities, was not a new concept. Fannie Mae and Freddie Mac had been doing it under government sponsorship since the 1970s. What was new in the early 2000s was the extension of this process into subprime lending, the progressive erosion of underwriting standards, and the creation of complex structured products, collateralized debt obligations, synthetic CDOs, credit default swaps, that distributed and obscured risk throughout the global financial system in ways that regulators, ratings agencies, and many market participants failed to understand. The private label mortgage-backed securities market grew from less than $100 billion annually in the mid-1990s to over $1 trillion by 2006, funded by a global savings glut that directed Asian and European capital into American mortgage risk at yields that systematically underestimated the probability of default. When the U.S. housing market peaked in 2006 and began to decline, the consequences moved through the financial system with a speed and severity that surprised almost everyone. The failure of two Bear Stearns hedge funds in June 2007 was the first visible rupture. The money market froze in August 2007 as banks stopped lending to one another, unable to assess the mortgage exposure on any given institution's balance sheet. Bear Stearns itself failed in March 2008 and was absorbed by J.P. Morgan Chase in a transaction engineered by the Federal Reserve, which agreed to absorb $30 billion in Bear's toxic assets, the first of many boundary-crossing interventions. The nationalization of Fannie Mae and Freddie Mac in September 2008 followed. And then, on September 15, 2008, Lehman Brothers, the fourth largest investment bank in the United States, filed for the largest bankruptcy in American history. The government's decision not to rescue Lehman, in contrast to its rescue of Bear Stearns, produced a panic of 1929-like proportions. The commercial paper market froze, the money market fund reserve primary broke the buck, and the global financial system came within hours of complete seizure. The TARP legislation, the Federal Reserve's expansion of its balance sheet through quantitative easing, the stress tests of 2009, and the eventual passage of the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 constituted the policy response, the most substantial financial regulatory intervention since the New Deal. Dodd-Frank created new resolution authority for failing financial institutions, mandated clearing of derivatives through central counterparties, created the Consumer Financial Protection Bureau, and imposed the Volcker Rule, which restricted proprietary trading by banks, a partial echo of the Glass-Steagall separation it did not fully restore. From the trough of March 2009, when the S&P 500 closed at 676, the American stock market embarked on what would become the longest bull market in its history, fed by a decade of near-zero interest rates that made bonds unattractive relative to equities, by massive corporate share buybacks funded by cheap debt, by the extraordinary profit growth of the technology sector, and by the progressive institutionalization of equity investing through 401k plans and passive index funds. The S&P 500 rose from 676 in March 2009 to over 3,700 by the end of 2020. The COVID-19 pandemic produced the fastest bear market in American history, a 34% decline in 33 days in February and March of 2020, followed almost immediately by the fastest recovery, as the Federal Reserve deployed every tool in its arsenal within days and Congress passed the largest fiscal stimulus in American history. By August 2020, the S&P 500 had recovered all of its losses. By the end of 2021, it had reached 4,766. The 21st century market is, in its mechanics, its scale, and its participants, a radically different institution from the Buttonwood tree gathering of 1792, yet its fundamental dynamics, the oscillation between rational pricing and collective psychology, between genuine innovation and speculative excess, between the drive for deregulation and the aftermath of consequent crises, are recognizable in every chapter of its history. High-frequency trading firms now execute millions of transactions per second using algorithms operating in microseconds, yet they are engaged in the same arbitrage of price discrepancies that Jonathan's Coffeehouse regulars pursued in 1700. Retail investors using the Robinhood app during the GameStop short squeeze of January 2021 were engaged in the same collective speculative behavior as the tulip traders of 1637. What the full arc of this history reveals is that financial markets are not primarily technical systems but social ones, creatures of law, politics, technology, and psychology in roughly equal measure. The market's periods of greatest instability have consistently coincided with the widest divergences between the complexity of financial innovation and the adequacy of its regulatory governance. The crises of 1720, 1837, 1873, 1907, 1929, 1987, 2000, and 2008. Each followed periods of rapid innovation in financial instruments or market structures that outpaced the institutional and regulatory frameworks available to manage their risks. The history also reveals an irreversible trajectory of democratization, from a market accessible only to the wealthy merchants of Exchange Alley to one in which a smartphone app can give a warehouse worker in Ohio real-time access to the same securities available to the largest hedge fund in the world. The direction of travel is unmistakable, even if its consequences remain deeply contested. Whether that democratization serves the financial security of ordinary Americans or merely exposes them more efficiently to the volatility and complexity of a system they cannot fully understand is the central unresolved question of American financial life, one that the market's next crisis will eventually force the nation to answer again,